Good afternoon, dear students. Welcome to business studies class. In the last class, we had already discussed about the techniques of managerial control. Okay, so in this managerial control, we have classified into two types. One is traditional techniques, another one is modern techniques. Okay, so in the last class, we are discussed about the traditional techniques of managerial control. So in these traditional techniques, including personal observation, statistical reports, break-even analysis, and finally the budgetary control. So these are all those things we are including in the technical managerial control. So in the last class, we are going to discuss only 2 points of technical control, that is called as a personal observation and statistical reports. Okay, so today in this session the remaining points we are going to discuss. So next one is the third traditional techniques of managerial control is break-even analysis. Okay, so in this break-even analysis, this is one of the traditional techniques we are going to use to controlling the management system. Okay, this break-even analysis means it is one of the technique used by the managers to study the relationship between cost, volume and the profit. Okay, main thing it involving the cost and profit. Okay, so sales minus cost is equal to profit. So this is one of the traditional technique the manager can use. The main concepts of traditional technique is cost and the profit. Okay, so it determines the probable profit and losses in different levels of activities the organizations are going to perform. Okay, the sales volume at which there is no profit or there is no is called as a break even point. Okay, so this, what is this break even point means? There is no sales and no profit. The point should be considered as the break even point. So I'll show this in this figure. So this is the cost, this is the sales. So this is this line, it should be considered as the sales volume. So both loss and profit margin should be shown here. So there is no profit and there is no loss in this point, should be considered as a break even point. Okay, break even point means there is no profit, there is no loss. This is one of the neutral stage. This will be considered as a break even point. Okay, it is also one of the useful techniques for the managers as it necessary for it use in different managerial levels. Okay, so main in different levels of activities we are going to perform into the organizations. Each and every managers can be use these techniques to analyze the cost and profit. Okay, so that is called as a break-even analysis. Okay, so this break-even analysis helps a firm in keeping a close check in various different levels of cost and determine the levels of activity should be performed into the target levels of profit into the organizations. Okay, so in the management, in different activities should be performed into the organizations. They are investing the amount or investing or spend certain cost to producing the product. So after producing, they can go to sell the same product. So finally they can earn certain profit. So they can possible to earn how much is cost we can go to spend and how much is profit we are going to earn. So we can go to mention the differences between these two. That's why we are going to preparing this break-even analysis. Break-even analysis is helpful to find out the cost and profit. Okay, so here I shown one of the picture here. So in this figure, so this shows the cost and volume. So in lakhs. Okay, this is the sales volume in thousands. Okay, how much of lakhs of cost we are going to increase it. Then this is the sales value represent into the thousands. Okay, then so this is the fixed cost and the variable cost. Both the cost should be considered here. Okay, so this space is called as a fixed cost. So in this between these two facts, so this is the variable cost. Okay, so business sometimes having certain profits and also losses. Okay, here. So this is the point should be shows the break-even point means this point should analyze there is no profit and there is no losses here. Okay, so that's why how to find out this break-even point means break-even point is equal to fixed cost divided by selling price per unit minus variable cost per unit. This is the formula for using for calculating the break-even point. Fixed cost divided by selling price per unit minus variable cost per unit. Okay, fixed cost. So this is the fixed cost means how much is it? The already cost is fixed. In variable column is changeable cost. Okay, so that's why fixed cost divided by selling price. Selling price per unit minus variable cost. Just we can find out the break even point. Okay, this is the concept of break even analysis. This is one of the traditional techniques of managerial control we can use to identifying the cost and profit in each and every business organization. ಅಂದರೆ ಈ ಒಂದು ಬ್ರೇಕ್ ಇವನ್ ಅನಾಲಿಸಿಸ್ ಅಲ್ಲಿ ಕಾಸ್ಟ್ ಮತ್ತೆ ಪ್ರಾಫಿಟ್, ಓಕೆ, ಖರ್ಚು ಮತ್ತೆ ನಮ್ಮ ಒಂದು ಲಾಭಾಂಶವನ್ನು ಅಳತೆ ಮಾಡಲು ಈ ಬ್ರೇಕ್ ಇವನ್ ಪಾಯಿಂಟ್ ಅಥವಾ ಬ್ರೇಕ್ ಇವನ್ ಅನಾಲಿಸಿಸ್ ಕೂಡ ಹೆಲ್ಪ್ ಆಗುತ್ತೆ. ಸೊ ಇದರಿಂದ ಒಂದು ಸಂಸ್ಥೆ ಅಥವಾ ಒಂದು ಆರ್ಗನೈಸೇಷನ್ ಎಷ್ಟು ಖರ್ಚು ಮಾಡಿದೆ, ಎಷ್ಟು ಸೇಲ್ಸ್ ಆಗಿದೆ, ಎಷ್ಟು ಲಾಭಾಂಶವನ್ನು ಪಡ್ಕೊಂಡಿದೆ ಅನ್ನೋದನ್ನ ಸೊ ಇದರಿಂದ ತಿಳಿಬೋದು. ಇದು ಒನ್ ಆಫ್ ದ ಟ್ರೆಡಿಷನಲ್ ಟೆಕ್ನಿಕ್ಸ್ ಆಫ್ ಮ್ಯಾನೇಜರಿಯಲ್ control. Okay, so this is the one factor. So next one is the next point of traditional technique is budgetary control. Next one is budgetary control. Fourth is so budgetary control. This is also another one traditional techniques of management. So this budgetary control, it is also one of the technique of managerial control which is advance of the form of budgets to the results. Okay, budget. So you already know this concept of budget. Budget is nothing but expected results expressed into the numerical terms. Okay, expected. So in the budget means you are going to prepare on the basis of the future and circumstances. On the basis of the future and circumstances, we are going to prepare certain budgets. Okay, actually our budgets is preparing the actual results are compared with the budgetary standards. Okay, budget is just not one of the accurate thing. Just we are going to assuming the future circumstances. On the basis of that, we are going to preparing this budget. Okay, after that, after preparing this budget, just we are going to analyze, we are going to compare with budgetary standards and actual performance, what is happening to the organizations. Okay, so budget is example cash budget, sales budget, material budget. Okay, this all is various different types of budgets we are going to prepare into the organizations. Okay, so the budget is one of the quantitative statements for a definite future period for the time of obtaining a given objectives. Okay, budget it is one already told. It is we are preparing one of the quantitative term. Okay, just we are going to express in numbers or numerical terms. Numerical terms. Okay, this one of the future oriented. Budget is future oriented, expected result expressed into the future. So okay, on the basis of the future and circumstances, just we are going to mention the budgets on the basis of the quantitative terms. Okay, so it is obtaining given the objectives of the business. On the basis of the business objectives, we are going to preparing these budgets on the basis of the quantitative terms. Okay, it is also one of the statement which is reflect the policy that particular period. Okay, so budget it is always involving one of the particular period of time. Okay, so particular period it is involving, for example, 3 months budget or 1 year or the annual budget or 1 month budget, like that. Okay, it involves one of the particular period of time. Okay, so it will contain figures of forecast in both terms her time and quantities. Okay, I already told. Okay, it is the 3 months budget, 3 months period of time. using for this budget. It is also considered the time. This is the 3 months or 1 year, and also mention it should be quantitative. Quantitative is mentioned one of the basis of the figures. Okay, so that's why each and every budget including both time and quantities. Okay, for example, so we are spent 1 lakh rupees for 1 month period of time for the production activity. This is one of the example for that. Okay, so we are producing 10 units. We can spend 1 lakh rupees for 1 month period. So like that only we are going to mention this budgets. Okay, this is also one of the traditional techniques of management or control. Okay, so these budgets involving this various advantages here. Okay, what are the various different advantages of this budget means? So budgeting is focus on specific time and targets that helpful to attain objectives and goals of the organizations. Okay, I already told each and every budget it including time and particular period. So that's why on the basis of this budget, it can possible to easily achieving our organizational goals and objectives. Okay, this is